maybe jump into introductions. Maybe Kim, start with you.
Okay. Hello, everyone. I'm Kim Lisa Taylor. I'm a corporate securities attorney and the founder of syndicationattorneys.com. We're a securities law firm that creates offering documents for people who want to raise money from private investors, either to syndicate an individual property or to do a large fund and buy multiple properties. So I met Val a while ago, and we have him as a preferred vendor on our website, and he invited me to come and speak to all of you. So I'm pretty excited to be here. Thanks for the invitation, Val.
Thanks for joining us.
Yeah.
Charles, you want to jump in? The quick introduction.
Can you hear me? Yep. So my name is Charles Fisher. I'm at JLL, so a small firm you all might know about. And within the JLL organization, I sit within capital markets, but specifically in a new group called Risk Advisory. And within Risk Advisory, we're taking proprietary JLL data and applying it to machine learning models and other analytics to help our clients make better decisions. So really, we're working with large institutional lenders, so large lenders to value the loan collateral on their books. So that can be thousands of properties. And we also work with owners just to value their properties and do risk analytics on their portfolio. And then proprietary ESG risk, so saying how ESG risk is impacting the value of their portfolio. So I'll show you some of that today. And thanks, Val.
Thank you. Let's go to Charles Fisher.
I think you got me already.
Did you drop?
Can you hear me?
I'm sorry. I was thinking David Fisher. I get you all confused on mine. All right, sorry about that. Bruce Gibson.
Yeah. Yes. Sorry, I just joined. I didn't know if you asked a question or something.
No, we're just doing quick introductions.
Oh, Bruce Gibson with Senior Capital Advisors out of Miami, focused exclusively in the senior housing space on the brokerage and also capital and debt sourcing side.
Great. Jim Fitzgerald.
Jim Fitzgerald, Boston, Mass. Focus on multifamily mixed-use buildings in the Boston marketplace.
Yeah. How about Ian Stewart?
Hey Val, Ian Stewart with Goldberg Companies out of Cleveland, Ohio. We are a primarily multifamily developer with assets in Cleveland and regional office in Charlotte and properties in Charlotte, Nashville, Raleigh, Charleston, and parts of Florida.
Mark Leese. I'm pronouncing that correctly.
You are stating that correctly, yes. At least like when you rent. I'm a consultant, Argus consultant. I've been doing consulting since 1992 around Argus and Argus legacy products. My specialty is getting access to the Argus database. I've written some applications Excel applications that pull data directly from Argus into Excel. Also do a lot of SSRS custom reports.
Cool. Thanks. Merrick.
Hey, this is Merrick Metcalf with Essex Lane Management. We're a co-GP equity provider based out of Atlanta, Georgia, and strictly focus on kind of the southeastern United States across all property types and all asset classes.
Thanks. Stephen.
Hi, this is Stephen Edwards with Brandywine Homes. We're a infill developer here in Southern California. been in business for 30 years. We specialize in infill, townhome, for sale, for rent, multifamily as well in our marketplace.
Nice. Zach.
Hey, can everybody hear me? Hey, Val, this is Zach Ashton with Dillwig Companies based in Raleigh, Durham. We're a Southeast-based real estate operator, investor. Go from Raleigh, North Carolina, down to Tampa, over to Dallas, and unfortunately, we've been dealing primarily in office the last decade. So we're looking to repurpose and do something else.
Nice. Long time no talk. I get out of the Florida heat. I'm in Denver now, so it's much nicer. All right, so yeah, let's jump into our agenda. So Charles, we've got you first. Yeah, feel free to just jump in and run down kind of what you do and your services and however you want to present it.
Sure. I think you said about 15 minutes or 5 minutes, or how long was it?
Yeah, I've got you for 10, but you feel free to. Yeah.
Okay.
We're flexible.
Sounds good. I'll do 10 minutes. Not a big deal. I'm happy to stop anyone for questions and the such. So can I share my screen? Yeah, looks like I can. Oh, if you can disable that, my piece here.
Yeah, let me enable. All right, you're good now.
Great. So let me share screen 4. Great. You see what am I up? There it goes. So if you can see my screen, just happy to just quickly go through this. It's sort of an interesting new product. So as I mentioned, JLL Risk Advisory is a completely new business line within JLL in the capital market space, where we're providing analytical analysis of client portfolios, whether the lender or the owner. And we use proprietary JLL data that we can pull from anywhere, or we pull from public sources, and we mash that into machine learning models to help with insights into clients' portfolios. So again, we're seeing a lot of challenges in the global space around uncertainty, around values. How do you look at risk when there's not many transactions occurring? And how do you become more efficient and assess those risks? So really what we've been developing at JLL, which is pretty new and very different, is this risk analytical services, and really trying to take a comprehensive look at risk across the spectrum. And we've really broken it down into 5 major categories, which you can see on the left, and within 54 individual risk metrics. So again, thinking of it as a very much more detailed SWOT analysis to go and look at these properties en masse, or even just at one at a time. And really, the way that we've been working with clients, and I'll show you a second, is running our analytics off of their portfolio. We can even, I'll show you, do it off of a hypothetical asset. So, valuing either the portfolios that you own today or that people have lent on, or even saying, I want to value a 1 million square foot warehouse every 2 miles across the United States, and see what the model says is the value, what is the liquidity, and what is the momentum in that market. So it's been really interesting what we've been doing. So again, one of the big things is we're doing a lot of work outside the United States, because our models work in 70 different countries. We use 300 different data sources, and we sort of come up with a single source of truth for investment grade properties. And we use that to train our models to make predictions around the value and the liquidity risks around that. So going quickly to here, this is a 1-pager, which I'm happy to also share with you. But what we've really built is we can do competitor benchmarking. So we're actually working with a REIT right now and valuing all of their competitors' properties using our models to say, how is this competitor's property relate to theirs? We've been doing sector and yield analysis. We just did something for a sovereign wealth fund where they wanted to know how Sydney retail is different than Paris office versus stuff in the United States. We've also been doing some interesting stuff, which I'll show you, around market risk. So what's the value at risk for properties? So again, this is looking at if you think about a bell curve, what are the tail risks, and what are we seeing on those tail risks for specific properties and how they're selling? So a lot of office space, we're seeing selling at the bottom end of that tail. So if it says there's a 25% value at risk, it's selling for usually 25% discount, which is interesting. We've also been working on what we call liquidity scores. So again, there's not much liquidity in the market, but we can take JLL transaction and bid data and apply that to a market. So if we know that we're selling a property in downtown Dallas, we know how many bids it got, what was the bid-ask spread, how long was it on the market, and the such. So we're using that to help inform liquidity. So again, sort of interesting things that we're applying to our client portfolios. An interesting thing is we worked on a 300 property portfolio in the Americas and Europe, and we pretty much applied what you see there, where how do you think of us as the top of the funnel, where they can look at all their assets, determine what's going on with those assets. Do they need them to get reappraised? Do they think about selling them? Do you want to reduce exposure in certain geographies? And it's done at scale, and it's much more cost effective than going in and getting an appraisal. And it's much faster than doing that too. I can run a portfolio if I have the data in a couple minutes to get it done. So it's been very interesting with that. And I'll quickly, because now that you sort of have an idea of what we do, I'll sort of show you, this is the first level deliverable that we're actually working with clients on. And again, this is an example, but you can sort of see where, this is just a bunch of industrial properties. If we have a historical valuation, or it could be internal or external value, we then run a couple of different models, whether it's a price model to see how the price has changed again over time. What is the percentage change versus a year ago or 6 months ago? We then run a sales AVM. Think of this as a comps approach, so we can pull the 30 different comparables that we think sort of help inform this. Again, we're working on a capitalization model too, which will help keep on refining the model. So it's not just, when you think about a DCF approach, an income approach, we then produce a confidence score, how confident we are in that value. And then we start looking at what is the price risk potentially. So based off of this value, what do we think that dispersion is on a risk basis? So is it really risky or is it less risky based off of that changing in value? A lot of banks actually don't want a value, but they just want the price risk because the regulator's looking over their shoulder, which has been interesting. But then what we can do is we can start looking at what is the value at risk. So again, this is what is that downside risk, and you sort of normalize the data. And you can do it by market. What do you think the risk is as a whole? Is it high level risk or low level risk? And then we start applying, again, liquidity data. So is this a liquid market? Yes or no? Is the liquidity high? Is it declining and the such? And then clients can then sort of make their own decisions. Some of the other things that we're building in are environmental risks. So we have an environmental data set we can pull from depending on the client, the sustainability, and then we're building in other indicators as we get that data globally. So it's a way that you can run it off of. In this case, I just did 50 assets, but there's no difference between running 50 versus 1,000 versus 50,000, because we're working with a bank right now that has about 50,000, a 50,000 property loan book. And it's just it takes 5 minutes. It doesn't matter because it's just pulling from the data and running it. So with that, that's looks like I have a couple minutes. So happy to answer any questions. Because I know that's probably a lot throwing at you. It's very different. It's not a BOV. It's not an appraisal, USPAP appraisal. It sort of sits in between there, but it's definitely not something you can use for loan origination. It's more for portfolio monitoring. But you can do it. The interesting thing, as I mentioned, which we're talking with some larger owners, is how do you run it across a new geography? We could value, as I said, 1 million square foot warehouse across the US. We could do it in Spain to help uncover where potentially there's some discrepancies between value and the market. So with that, I'll take a pause.
Cool. Yeah, thank you. Any questions, Charles? Is there a size of portfolio that kind of a minimum that kind of makes sense for your clients?
Yeah, I think for what we're finding is if you have, only a couple properties, people, just open up an Argus model and run it, or open up your Excel model and do it there. The sweet spot we're saying is 50 properties or more, because we could run it, we can run it every month. You can run it every quarter, but really it's 50 properties or more, because the question is how much more work is it just to open up an Excel model or an Argus model and do it there.
And, asset class agnostic. You can pretty much do
Yeah,
any asset class, correct?
yeah, it's pretty much we pretty much can pick up every asset class. Again, the core four are the best, and then you have to sort of extrapolate from some of the other ones. But core four we're really good on, and then we pretty much cover a lot of the other asset classes. There's transactions, sufficient transactions right now. Yeah, and it depends. Like our
Core
South
four would be
African
industrial.
model. Yeah, industrial, multifamily, retail, office is the core four. And then, again, some markets are better than others. Like our South African model is not as good as the US model, which isn't as good as our German model, type of thing. So it can really depend.
Yeah. Cool.
Yeah, so it's something different. And hopefully we're building out a brand new interface on this to make it much more interactive with some of the data. And we're just improving the models and sucking in new data sources and working on some bespoke consulting engagements for some small private equity firms. So where should I look to build data centers or buy data centers? And then you pull in the electricity data and other comps around that. So it's been interesting. Again, it's about how do you create a bespoke sometimes for the client, and sometimes the banks don't need a bespoke. They just want the whatever is generic.
Yeah. So clients are using you guys to kind of inform their acquisition strategy.
Sometimes, yeah. Again, we're going in that direction. Right now, it's sometimes it's about their current holdings, but I foresee eventually, you'll be able to run the model on hypothetical buildings. So I want to buy a 1 million square foot warehouse. What does the model say the value is every 2 miles across the US? So what is the value between downtown Chicago versus the near suburbs versus the far suburbs? What does the model say the value is of that building? And then you could use that to help inform where you want to look based off of that, or if what is in the market right now versus for sale versus what the model says it's worth.
Cool.
Yeah, I wouldn't trade securities on it yet, so I wouldn't go out and buy CMBS, and but it's definitely we're in the crawl phase. There's a lot of hype around AI, but I wouldn't. There's a long way it needs to go, but it's going to be very interesting. It's going to be, as I've told people, I have a thought piece on this. AI is not going to replace people. It's going to replace tasks, not roles. But people who use AI will replace people who don't use AI in the end. What discount rate should I use? What comp should I use? Where is there risk in the portfolio? Real estate's 10 years behind residential and some of their models, and then it's 20 years behind general financial markets. So there's a lot of improvement.
Yeah. Cool. That's good. Any other questions, Charles? Cool. Yeah. Thank you.
Yeah, I guess
Appreciate your time and for sharing that.
Yeah, if anyone wants to reach out, they
Yeah.
can.
How can people get a hold of you?
Yeah, I can share Val the quick one pager, and if anyone wants to reach out and talk, I'm happy to talk and tell you about what we're doing. So yeah.
Great. Sounds good. Cool. Thanks. Let's go to Kim. And yeah, Kim, love to hear more about what you're doing now, what you're seeing in the marketplace, what operators need to be thinking about, or whatever you want to share.
Yeah, so let me just share my screen for a moment if I can. Let's see. So just a little excerpt from my website. We really focus on teaching people how to raise capital for real estate legally, or helping those that are already doing it scale up. We work with a lot of people that have never raised capital before, all the way up to people who are raising $100 million funds, primarily real estate, but we do have an attorney on staff that can handle non-real estate offerings and has taken companies public and done all kinds of other types of offerings. But our bread and butter is Reg D, private placement memorandums, operating agreements, corporate structures, and, getting all those things, components together and helping you understand what you need to present to investors and how to split the money with them fairly and accurately, and then introducing you to other services you need as you go along the way. That's how we met Val, because we do have a podcast called Raise Capital Legally. I think it's got something like 90 episodes now, and Val was one of ours. So we put him on our trusted vendor website page so that other people can use their services. We also do have a marketing division. We used to tell our clients you need to create marketing materials to support any fund that you're going to do. And they were having a hard time, and I was having a hard time finding people that could do a good job of it or do it in a timely fashion. So we just created our own division that does that for our clients, and we can also do it for other people's clients as well. But putting together operations plans, pitch decks, one-pagers for funds is a lot of what we do. But we can help with a lot of that. We do have, I've written 2 books. How to Legally Raise Private Money is kind of an introductory book. It's short, it's just step by step how to syndicate for people that have never done it before. How to Raise Capital for Real Estate Legally is a more advanced version. It goes more in depth, talks about things like funds of funds, how to determine your splits with investors, what waterfalls typically look like. Goes into a lot of the more deeper regulatory compliance issues and different types of structures that people use to raise money. Those are both available for free at our website. If you go there, you can go to, there's a free book tab, and we'll physically mail you a copy, or you can get them on Amazon. The How to Raise Capital Legally for Real Estate Legally is also available on Audible, just recently published on Audible. So if you like to listen while you're commuting, but we work with real estate syndicators, fund managers, joint venture partners, people who are partnering with private equity, or small business owners. Help a lot of people in those spaces. So that's pretty much about us, but please do check out our website. We do have both the trusted vendors and the free resources tab. In the free resources, then you'll find our ebooks, our articles, frequently asked questions, other people's podcasts I've been on, and a lot of other just material to support your capital raising business, making sure that you're keeping it all legal. So what are we seeing now? We're seeing a lot of people. When I started in this industry a long time ago, we were seeing a lot of people doing 60-40 splits on syndicated properties. And we've evolved from that world into now where 70-30 seems to be the norm. 8% preferred returns have still been the sweet spot to get investors to write checks for decades. That really hasn't changed. We do see some models where people are maybe offering lower preferred returns in the first couple of years of operations and then graduating up to a bigger preferred return after they do some value add component, or if it's a development project, after they get the project up, occupied and running. So, all different variations of that. Still seeing investors wanting returns in the mid to high teens. That's hard. It's challenging in the multifamily environment because there's so much competition in that market. There's less. Every time I turn around, I hear about a new person who's out training people how to buy multifamily. So there's a whole lot of people, trainers out there, training an army of people that are out competing for all these properties, and some are better trained than others. So they may stand back and wait to see if the ones that are making the crazy offers actually go through. A lot of times they don't. But another thing that we are seeing is that lenders are, who wouldn't talk to anybody 3 or 4 months ago are now coming back, and our clients are getting multiple offers from lenders on properties that where they wouldn't talk to them at all before. So the lenders are starting to see that the opportunities are there again. Maybe sitting and deciding, hey, we still got to get some money deployed, even though the markets have changed. So that's the world we're in right now. You know, we hope that there's, you know, going to be some changes on the horizon, but as long as the interest rates remain high, then, you know, sellers are, I think, at a point. It took them a long time. Usually we expect about a 6-month lag between when interest rates rise and sellers adjust prices. This time we saw about a year, a little over a year. We are seeing a lot of, you know, current clients and other people's clients in the marketplace with syndicated properties that are having some financial challenges. And when I ask them what's the problem, it's usually always they held onto the project during COVID when if it's a multifamily, there were eviction moratoriums, you know, couldn't get labor, the supply costs escalated, everything took longer. And so instead of getting their repairs and properties optimized in 2 years, now it's stretching out to 3 or 4 years. So, and then those that purchased with bridge debt are sometimes up against some maturity dates on those loans. So they're at a point where the lender, you know, they can find a lender that will do the financing for them, but of course they want a lower loan to value ratio now, and the property is valued less because of the interest rate hikes. So that requires the syndicator to bring some additional money to the table. So we're seeing a lot more preferred equity funds that are looking at some of those properties. Not seeing a lot of preferred equity that's looking in the B and C class properties that a lot of our clients have. Definitely know of some that are you know, interested in investing in the A class. The lenders having in some cases even suggested, hey, why don't you go out and find some preferred equity, and as long as they don't have takeover or voting rights, you know, but they get right to first cash, then you know, we won't bother you about that. We'll let your loan stay in place. And so that's kind of what we're looking at. You know, lots of restructuring and you know, trying to help clients, and that's certainly something we can do, is look at their current structure and try to help them figure out, you know, how they can insert new capital. We have had some clients that have successfully raised capital through capital calls, and what they've done to incentivize their investors is actually offer them a complete pass-through on all returns on the additional capital contributions. So instead of, you know, the 70-30 or 80-20 split that they were offering before, they're saying, hey, it's 100% pass-through plus a priority return of any additional capital you contribute. And the rest of your investment will continue on with the waterfall and the terms that we had in the beginning. So that's kind of what we're seeing in the trends. You know, we're of course all waiting to see what happens in the election, because that's always going to have an influence on interest rates and you know, the economic outlook of the country. So we're just waiting to see how that all shakes out, and hopefully it will, you know, be positive. But if it's not, then we'll you know, deal with whatever happens. So, you know, our experience is when banks won't lend or are not able to lend on the terms that the investors want, then they still syndicate. They just raise more money, and they might offer lower returns to their investors. So we may see another shift in investor returns in the next few years if that's the way things continue. So, any questions? I'm happy to answer questions if anybody has any.
This is Merrick. I've got a quick question.
Okay.
What
Yeah, go
are
ahead,
some
Merrick.
of the challenges these syndicators face? You know, I know sometimes they raise money through accredited investors only, and some go beyond that to non-accredited investors, which is an entirely different process. I mean, maybe you can help me understand the differences between the two and what some of the challenges associated with the latter are.
You know, we have primarily built our practice around teaching people who've never raised capital before how to do it, and they all have to start with non-accredited investors. So, you know, I've heard a whole lot of attorneys out there saying, oh, no, you can't use non-accredited investors. But to be honest, it's 80% of the investing public are, you know, like the last SEC estimates were only 18% of the investing and possible investors are accredited. That leaves, another 82% that aren't. And, before our clients build a track record, the people that will invest with them are people that they know. And, they usually know a whole lot of people that aren't accredited investors, so, the real difference, even though a lot of attorneys blow it up and make it sound like it's, significantly more difficult, it really isn't. The private placement memorandum, / disclosure document has to follow the SEC's guidelines for an offering circular for a Reg A plus offering, as far as just disclosing more information about the management team and their compensation, and certain, they go so far as to say what has to follow the title slide and what has to be on the cover page of a PPM and stuff like that. But beyond that, it's really not different. We've probably had, I started this firm in 2016. I've been doing this since 2008, and we've been writing non-accredited offerings all that whole entire time, and I've never seen any fallout from that any different from any other. And the fallout that has happened is usually because the manager, the fund manager, or the syndicator didn't do what they were supposed to do, or didn't communicate well enough with their investors as to what the actual situation was, and get their input on possible solutions. So I don't see it as a much bigger risk. If you don't have non-accredited investors, you're not required to have a private placement memorandum, but we always recommend it for all of our clients who have more than 4 or 5 investors anyway, just because it's, the way I explain it, it's an insurance policy for them. It's like, if you warn these people of all the different risks and you put it in front of them, and, there's 7 pages of risks that they read or are testing that they've read when they fill out their subscription agreement, then it's hard for them to come back and blame you for it if one of those things happens. So it's worth the extra $5,000 or $7,000 that it costs to create that, just to have that insurance policy. And you're going to raise enough money from your investors to pay back all your legal fees anyway, so why not let them pay for that insurance policy for the management?
Thanks, Kim. That was helpful.
You're welcome.
Any questions for Kim? My question with loan guarantees. Do you see co-GPs come in, guarantee the loan, get compensated for that separately within the equity waterfall, or what do you see there? Is it typically the GP, the originator, that's having to guarantee the debt, or do they often bring in people that can kind of guarantee the debt and get comp for it?
So yeah, it seems to be the topic of the day. We do weekly masterminds with our clients, and the whole topic today was how to split management earnings, or the earnings amongst the management team. And I usually look at it like a quadrant. I'm happy to show it to you if you want to take a look. Do we have time for that?
Yeah, go for it.
So we usually start with, what is the jobs of the asset manager? It doesn't matter if it's a fund, doesn't syndication, either way. You've got all these jobs that have to be filled. Think of it like a startup company that is deciding, who do we need to bring on that has the skill sets we need to make sure this company's successful. So you're looking for people that can fill these roles. And what I always say is, first of all, never more than 5 members of a management team, because it's just unworkable, and it usually ends up in dissension, sometimes litigation. 5 is a lot even. So make sure that people understand these are the expectations. They have to raise their hand to cover certain of these jobs, create a scope of work for them. If they don't perform, get rid of them, because they're just going to be dead weight. And one of the reasons I say no more than 5 is not just because of the dissension, but also because there's not enough money to go around. right? What ends up happening is 2 or 3 people do all the work. The rest of the people are just hanging on, and they're sucking up some of the income that the syndication or syndicator or fund manager could otherwise be earning, and they're the ones that are actually performing those tasks. But then once we figure out who's going to do what, then we kind of, break it into these quadrants. And this is my own, it's kind of my own assessment of what I've seen our clients do over the years. Like I said, we've probably helped over 500 syndication clients I have during my career. So, this is kind of the model that we see them working off from, is, kind of putting all those tasks into these little boxes and figuring out who does what and what all that job is worth. So if you can see, there's the loan guarantors down at the bottom. Typically what we see for loan guarantors is around 20%, and it's split amongst the loan guarantors if there's multiple guarantors. So for the underwriting purposes, lenders usually looking for up to 4 people. That's the max I've ever seen them allow, that will collectively have net worth equal or greater to the loan amount, even for non-recourse loans. And so those that do that usually split up that 20%, maybe according to how much they're guaranteeing, or maybe just equally amongst them. And then the raising capital part is usually 25 to 30%, and there for compliance, securities compliance, we always say everyone in management has a job of raising capital, but nobody gets separately compensated for it. So ideally, you want all the members of the management team to have a piece of each of these slices of pie, or at least more than just the lower right quadrant. You don't want people that are only raising capital and only managing their own investors, because that's, especially if you're using some kind of a formula that compensates them according to the amount of money that they raised. So, you never want to be under a regulatory investigation where they're asking how was it determined what your percentage interests were, and you don't want to have that person say, well, they plugged in this formula, this is how much I raised, so this is how much I got, because that then begins to look like transaction-based compensation, which the regulator would view as a commission, and nobody can earn commissions except for people with the appropriate securities licenses. So the co-GP model, you really have to make sure that people understand they're expected to do more than just raise capital, and they need to volunteer for some of these other jobs, or it's not going to be a defensible position for them or for the offering exemption that the issuer is trying to have. So that's kind of my take on it. Do you guys want me to put a link to this in the chat? Okay, I can do that.
Yeah, that'd be great.
Yeah, that'd be awesome.
Yeah, that'd be wonderful.
Very cool.
Yeah.
Cool. Thanks. Any other questions for Kim? All right, probably need to move on. So Peter, saw you joined. Peter Neal. Do you want to jump in and discuss what you're working on? I think you had a couple deals that you're working on that you wanted to potentially share with the group.
Yeah, so we kind of put into action everything that Kim was talking about. And Kim, I don't know if you remember, we met a long time ago at we were booth buddies. I think, I don't know if it was Eddie Speed or it was in California or something, so it's great to see you. And we manage a couple different 506c funds. We'll have to talk about the Reg A stuff, because I've always had an interest in that, but I've always been under the perception that there's additional cost when it comes to, on an annual basis, when it comes to reporting. And then, my experience has always been with the people usually putting in the least amount of capital are the ones that tend to take up the absolute most time. So you kind of factor that in as well. And I've had investors that have gotten into Reg A's where they got into trouble because they weren't able to raise enough capital for whatever reason. If it was, how they were advertising, or maybe they were taking $100 offerings and stuff like that. And then at that point, your marketing budget has to be gigantic so that you have enough volume to raise a significant amount when it comes to $100 investments. And if you're investing in multifamily or anything commercial, you're going to probably need a good couple bucks to get involved. So what we do is essentially syndicate, but for single family homes. So instead of buying, large apartment complexes or, self-storage or car washes or something like that, we raise capital from accredited investors through the 506c funds. And then we utilize that capital for the acquisition and the construction money to purchase, typically distressed, that's really our bread and butter. We do all of the construction in-house, so vertically integrated in that sense. And then we do the property management. So a lot of what we focus on is more on the buy and hold side. So and a lot of what we do is workforce affordable housing. So our model is typically going to be, we like to be somewhere on the acquisitions and purchase side to about $100,000. Could be as high as 130, could be higher than that. We just like to make sure the after repair value is going to justify it. But in that 100 to 130 range, we're typically going to see an after repair value as low as $165 and as high as maybe 200, 210, something like that, with an average of about 185,000. So with a 70% all-in refi, we're getting almost all of our capital back. Some cases we are getting all of our capital back. And then we're just redeploying that consistently. So the funds that we manage, some are structured in a one's structured much more traditional. So we pay a preferred return and then we split the profit and the equity and above the pref. And then the other funds are kind of structured to feel like private capital. So they compete with like a hard money fund. So instead of somebody going to a hard money fund and investing there, and then that company goes and lends it out and creates a spread between what they're lending it at and points they're generating and things like that. We allow people to invest directly with us. They can get a fixed rate return and on a fixed term, and we just utilize that capital for the construction and the acquisition cost. And then ideally, we like to do portfolio refis. So if we can, turn the capital through a refi instead of having to sell the property, that's great. But there's certainly advantages of doing a combination of both the sales and then, keeping properties in the rental portfolio as well. So because of the way we're structured, having the construction in-house and the property management, the scattered site single family makes a lot of sense for us. Kim said it right on point. Like there's so many multifamily operators out there that have kind of created these armies of multifamily investors and syndicators, and some of them have certainly got in trouble because they're not as sophisticated as maybe they should be, or as others are, that kind of thing. So for us, we felt that we were really structured to succeed in that scattered site single family space. We're in Philadelphia, we're in Baltimore. There's a little bit of institutional competition in the Philadelphia space. A lot of money from New York has come down and made deals very, very hard to do over the last couple of years. And in Baltimore, there's a little bit of institutional type stuff, but it's mostly, there's so many vacant properties. There's a ton of demand for rentals in that space. So we're able to consistently buy and make deals make sense in those areas right now. And then we'll get into the suburbs of both areas as well. Typically, we just like the workforce and affordable housing because we can diversify over more properties. When you start to branch out to the suburbs, property values tend to get higher. So instead of buying 2 deals in the city, maybe we can only buy 1 in the suburbs. So that's why we tend to stick with the row home type properties and attached properties in the more urban areas. But we do a lot with Section 8 rentals and government subsidies as well. I know our investors appreciate that. The process is a lot simpler on the single family side because the subsidies tied to the tenant, whereas in the commercial space, multifamily, it's typically tied to the building. So there's a lot of stipulations around it and how, how much you can increase and, all that kind of stuff. So for us, there's a lot of flexibility that we appreciate in the single family space when it comes to working with subsidies. But that's certainly not, I wouldn't say our main focus. That can also slow deals down as well. Sometimes it's worth it because you're going to get a little bit of a higher rent check than you would in the market. But sometimes that's not the case as well. And there's so much demand in the markets that we're in. We can be pretty picky when we're getting tenants into properties as well. So it's not like we feel uncomfortable, putting somebody into a non-subsidized property either. So that's kind of the gist of what we do. I'm happy to answer any and all questions. I think too,
Yeah.
one of the big topics right now, and one of the kind of the confusion people get is they compare what's happening in the multifamily space with interest rates and new construction, a lot of new development hitting the market, and what's happening in the single family space. And that's one thing that we felt we've been on the right side of the spectrum right now, because we still see just unbelievable demand and just a massive constraint when it comes to supply, especially in the markets that we're in and in these urban areas where it's, you're operating in the built environment. Whereas like multifamily, I think there's a lot of people in that space. There's a lot of there's been a lot of new construction. I know in the Philadelphia area, it's almost like every other corner has a new apartment complex going up. And then interest rates tend to affect that business a little bit differently as well. So I think single family is a good space to be in right now. And when you look at the data, it seems like they're still banking on, these supply constraints going on for some time, and, keeping those values, more on the up and up than on the down, which you hear in some of these areas, especially when it's tied to income. If your value is tied to income and you're not able to get those rent increases like you thought you were and stuff like that.
Yeah, I talked to a Section 8 investor, I think yesterday, who's saying he likes a single family for Section 8 because if one out of every five tenants you have issues with, it doesn't impact the entire building. He was just saying it gives you more flexibility. I thought that was interesting.
Yeah, I think there's, we like to be around 60 to 70% of our portfolio being subsidized through the Section 8. They tend to stay longer. Our experience has been is they're very happy to be in the property, because we're typically buying fully distressed. It's almost new construction we're handing over. Like if we're buying a property for $30,000, putting, somewhere between 80 to 100 into it, almost everything in that property is new. So that's a lot less work for us from a maintenance perspective moving forward. And then, this way somebody's moving into something where everything's new. All the appliances are new, your heating, AC system, everything's new. So we tend to see, the retention rate be very positive. And it's, just if and investors, been talking recession for some time now, whether it's happening or not happening, if we're in it, if we're not in it. All I know is that when you have those types of properties that are subsidized, it's a great place to be at a time like that. Because, right now, I think the tenant who pays the most might be paying $200 a month. But for a while there, the tenant paying the most was about $80 a month. So it's such a small portion of the rent that typically we don't see defaults when it comes to their portion, and then the other parts coming from the government. So you feel relatively confident about that coming in.
Great. Cool. Any other questions for Peter?
Peter, I'd be curious in that like workforce housing space, outside of the subsidized product on the market rate side, how are you doing your diligence on the renter and, getting comfortable with moving them in? There's been a lot of stories out there about, tons of defaults on these leases and things of that nature.
Yeah, well, it's always a numbers game. At the end of the day, you're never going to be batting 1,000 on it. You have we've been surprised by tenants where you have a good feeling about it, and it just doesn't work out. You know what I mean? And sometimes you have people who they could be doctors or attorneys, or they have really good jobs, high paying jobs, and the money's probably in the account at least from your due diligence, and they don't pay, and you got to go to court and stuff like that. So I would say you always got to come into it with the mindset of it's a numbers game. And like Val said, if you have, 5 properties and one goes down, it's better than having one and one goes down. If you have 100 and a few go down, you're in a better place. So I think that's one of the things that investors tend to get, tend to gravitate towards multifamily because they like the scale. You can scale in the single family space as well. We buy portfolios. The deals tend to be better on the scattered site individual side of the spectrum, because they are vacant or fully distressed, whereas the portfolios are typically occupied, so you have in place cash flow. So you're going to pay a little premium for that. You're going to pay a premium just for the fact that you're buying, 10, 30, 40, 50, 100 properties, whatever it is. But at the end of the day, you have to do your due diligence. We don't, the only things we outsource is agents and our website. So we tend to, lean on the agent, for their kind of initial go out and bring a tenant in, or bring a number of tenants in, with applications and things like that. And then we look at, what we've had past, kind of look at the data, I mean, who have we had success with before when it comes to jobs and stuff like that, and then just try to make a decision off of that. We tend to deal with a lot of families, and in the single family space, people that have families, that have multiple people living in the house, and so sometimes that's brings in multiple income streams, which is nice. And then just trying to invest in good areas as well. Just because you're investing in workforce and affordable housing doesn't mean you have to be in a war zone. You probably still want to be away from war zones where we like to see properties trading on rentals and on resale as well. There's some parts of town where you don't tend to see a whole lot of resales, or when you do, they're only investors buying in that area of town. We like to see regular retail buyers buying in the areas that we're in. That tends to mean it's going to be a little bit of a better neighborhood. When you're in the urban areas, chances are the schools aren't going to be that good to begin with, but try to get into the better school districts and all. So there's so many different aspects of it. But you're never going to win them all. But yeah, you got to do all the normal stuff when it comes to checking income and, credit reports and criminal histories and all that kind of stuff. And, go off of the data and what's worked in the past, but always be prepared to, have a certain level of default at the end of the day. And that's where the underwriting comes in too, where if you're expecting it up front, then you're probably not going to get hurt as badly.
Well, thank you. Thanks, Peter. That's really interesting. One other question is, how do you source your deals? Like, do you have multiple realtors sending you homes all the time?
Yeah, the nice thing about Baltimore is there's a couple auction sites, one in particular, Ashland Auctions, which does a ton of volume. And a lot of times we find that wholesalers and real estate professionals will bring us deals, and they end up on Ashland Auction eventually. So we do a lot through the auction sites. And then we also have a number of wholesalers and, agents that are bringing us deals that know what we want. And, the larger you get and the more properties you have, you tend to, people find you in the MLS and the public records and will call you and all. So that's been good to us. And then just, we do a lot through government service entities as well. We have like a note investment side of our business where we invest in distressed mortgages and all. So occasionally that will bring us some deal flow as well. So, but a lot of it tends to be through the auctions and then off market, agents and wholesalers bringing us deals.
Yeah, interesting. Yeah, cool. Well, appreciate it. Kind of against the hour, so yeah, thanks for everybody for contributing. And one thing I do want to put out there is if there's anything that y'all want to see in these meetings, or that would add value, let me know here or reach out individually. We're just trying to, just keep figuring out the format, but it's always valuable when we get together. But yeah, if there's anything y'all want to see, just let me know.
Thanks, Val. Really appreciate you organizing this.
Yeah,
Thanks.
thank you. This was really cool.
Yeah,
I
thanks.
told people.
Yeah.
Well,
All right, sounds.
I'm going to email. I just messaged you, Kim. I'm going to email you. I'm looking for. Let's catch up.
Okay, sounds good. Thanks.
Okay. Thanks, Val.
Yep. Thank y'all. See ya.